Hello, this is your daily dose of financial market trends. Meta just dropped 7% in a single day, dragging the entire tech sector down with it, and the bond market chaos behind this sell-off is something every investor needs to understand right now. Markets are in the red across the board this Tuesday. The S&P 500 closed down just over 1% to 7703. The Nasdaq took it harder, falling 1.5% to 26,326. The Dow held up relatively better, down 0.6%. The VIX spiked over 10% to 15.7, reflecting growing nervousness, and the 10-year Treasury yield climbed to 4.71%. Let's start with Meta, which is absolutely dominating market chatter today. The stock plunged over 7%, and the social media conversation around it exploded in a big way. What's driving this? Meta's getting caught in the broader tech sell-off tied to rising bond yields, which makes future earnings from growth companies look less attractive when you discount them back to today. There's also some geopolitical noise swirling around tech regulation that's adding to the pressure. If you're holding Meta, today's a reminder that even the mega-cap tech names aren't immune when macro conditions shift against them. Nvidia is another major story, down 2.5% today with everyone watching closely ahead of earnings next Monday. The AI chip leader is dealing with the same bond yield headwinds hitting Meta, and there's growing concern about whether the massive AI infrastructure build-out can continue justifying these valuations. Social media chatter around Nvidia remains elevated, which tells you people are trying to figure out if this dip is a buying opportunity or the start of something uglier. With earnings just days away, expect volatility to stay high. Broadcom fell 3.5%, caught in the same semiconductor sell-off. The company's positioned in the AI infrastructure boom, but today's price action suggests investors are reassessing how much growth is already baked into these chip stocks. With earnings coming up and bond yields climbing, the bar for Broadcom to impress is getting higher. On the flip side, U.S. oil fund jumped 3% today, and the spike in mentions tells you oil is back on everyone's radar. Middle East supply concerns are driving crude higher, and that's translating directly into gains for energy-related investments. If geopolitical tensions continue escalating in oil-producing regions, this could be more than a one-day pop. Now let's talk about the macro forces moving markets. First up is the global bond sell-off that's pushing borrowing costs to multi-decade highs. The bull case, given about a 35% chance, is that central banks step in with coordinated action or inflation data, finally shows convincing improvement, which would bring yields back down and give tech stocks room to breathe. The bear case, sitting at 45% probability, is that persistent inflation fears or massive government debt issuance keeps the pressure on, potentially triggering a sovereign debt crisis that forces deleveraging across the financial system and sends equities much lower. Second, we've got the US-Canada tariff standoff heating up. Canada's making last-ditch diplomatic efforts to avoid tariffs on $20 billion worth of goods. The bull scenario, at 40% odds, is they broker a deal that preserves North American supply chains and avoids new inflation pressures. The bear case at 50% is negotiations fail, tariffs go through, and we see retaliatory measures that disrupt automotive and industrial sectors while pushing costs higher for American consumers. Finally, there's a striking divergence in China, where 10-year bond yields just hit a 13-month low while Western yields surge. The optimistic take, given 30% odds, is Chinese authorities use this as a green light for major fiscal stimulus that revives growth and supports global commodities. The pessimistic view at 55% is these low yields actually reflect capital flight and deflationary fears, signaling China's economic problems are deeper than policy can fix, which would drag down global growth and corporate earnings. Mortgage rates sit at 6.67% for a 30-year fixed loan, and housing inventory has climbed to 9.3 months of supply. That's well above the balanced market threshold, and home price growth has slowed to just over 1% year over year. The housing market is essentially stalled, waiting to see if the Fed will cut rates enough to unlock affordability, or if we're headed for actual price declines. Mark your calendar for next Monday, August 26th, when Nvidia reports earnings. Given today's sell-off and the amount of attention the stock is getting, that report is going to be a major market-moving event. Here are 5 things worth watching right now. First, rising bond yields are changing the math on tech valuations, especially for high multiple growth names. So watch how these stocks react if the 10-year yield keeps climbing. Second, the semiconductor space is facing a credibility test with upcoming earnings, Nvidia especially, where expectations are sky high and the margin for disappointment is thin. Third, energy is benefiting from geopolitical risk premiums right now, and if Middle East tensions escalate, that's a sector that could continue outperforming while tech struggles. Fourth, the housing market is stuck in neutral with high rates and rising inventory, which matters for consumer spending and for homebuilder stocks that are pricing in an uncertain demand picture. Fifth, the divergence between Chinese and Western bond markets reflects fundamentally different economic trajectories, and companies with significant China exposure could face continued headwinds if their slowdown deepens. None of this is financial advice, just context to help you make sense of what's happening. That's your morning market digest for Tuesday. Remember, this is education, not advice. I'll be back tomorrow morning with another market breakdown. See you then.